And we are live on Oz Property Investor. We bring the big names and we have the big fun. And what's that in the back? Is that a? I don't know. I get distracted by his artwork. How you going anyway, Andrew? What's happening?
Good mate. Nothing much. I actually tell you the truth, quite a lot. I got deals that I'm working on. Was in Coffs Harbour on Monday for just the day.
The big
that
banana.
was love that place. It's a really, really good market for commercial property and also residential property. So flew down for the day and just to inspect a property on Rex Air, which was a semi-light plane. Never been on a semi-light plane before with the propellers.
Was that like more like the pilot or co-pilot or something?
You could basically see the pilot from where you were sitting. It's like a 40-seat plane. So wow. It's basically a light aircraft, and that's why it was so cheap.
I'll take it. Was it scary? Was it feel like you're going skydiving?
Well, because I didn't realize it was a light aircraft when I actually booked the flight. So I got to the terminal ready to board, and I'm expecting to board a 747, the usual walking down a plank, right up to the airplane. And they say, oh, no, get onto this bus. And I'm like, that's strange, but not anything to really raise an eyebrow about. And then they drove us to this light aircraft. And then I was like, wow, this is actually like scaring me a little bit. But then as soon as I got on the plane, it was fine. Like, I'm not scared of flying. I'm not scared of heights. I've actually done flight lessons before in a Cessna, so it was fun, real fun. But there was barely any people on the plane.
Have you flown into the side of a mountain, a place called Lukla in Nepal? That's where you got to, if you go and do an Everest or Everest Base Camp, you fly. Literally, it was one of the most dangerous top 10. I don't know if it still is, but when I did it, it was just insane. And you're in this small plane, so. Anyway, I didn't want to one up you, but it sounds like I did. So
For a while, I wanted to be a pilot, but it was way too late because realistically, it costs a lot of money to get your license. And I got onto it too late. But it is dangerous in terms of you always hear of a fixed wing aircraft coming down. You don't usually hear of a chopper coming down, but a fixed wing aircraft does have more frequent accidents. And I have kids, so it's just not worth it.
There you go. Joe, how are you going on that note, on that morbid note? How are we tracking today?
I'm all right. I am all right. Andrew Bean is one of the men that I always listen to when it comes to commercial property, but now he's walking into the world. He's walking into my world in a little bit. I am very much value add. I want to try and juice as much equity out of this deal as possible. But tonight's going to be about how you do that for commercial property. And what was the number? I need to find that number because I wrote it down because it sounded so ridiculous. You said like how to invest $15,000 to get like $2 million or something absurd, Andrew. What?
No, you asked me a question today on Facebook and you said, what's like the most amount of money to get like back? And you usually have like $2 to $3 for every dollar you put in. But with commercial property, you can add value with a stroke of a pen if you just know how to do it and the knowledge to be able to find the deal. So it's having the knowledge and having the understanding on how to actually add value to it. And with a stroke of a pen, you can add value, literally like 250K value with a stroke of a pen.
Oh, okay. That's why I'm excited. I want one of those pens.
It's not a special pen. It's just, this could do it. This could do it. But it's the knowledge and the mindset and the vision to be able to find it and understanding. If you know the data and you understand the market you're going into, then identifying the property is the main thing. And that is where the value is added.
Love it. Jeff, how are you, mate?
I'm feeling good, man. Exciting times. Just feel it's already inflation was 6.3% today, so it's continuing to come down. We're going to be deflationary before you know it. No, well, deflationary is negative, but it is disinflationary is the correct term, I believe. So just RBA pause again next Tuesday, and away we go. So
you think that'll happen? They'll go sideways again?
Yeah, potentially. So but this session is going to be amazing. So how good was that poster? Like it was fantastic. Like we got there with the King Kong and building massive buildings and adding excessive value in commercial deals. So we're going to be talking about that and many other things. Just lots of little Easter eggs in this session. So listen the whole way through because you will want to understand well, one of the things that Joe said about how to add $2 million with $15,000 worth of thing. That's insane.
I don't think that was it.
I mean, I just wanted to hear about that. We do that.
But
I'm sure
it actually, like, theoretically, it is possible. Theoretically, but I doubt it. But, you know, in terms of, like, calculation, it could be possible.
You build us up and you broke us down. Like, you told us about what
Hey,
happened.
250K is pretty good for no money in. Like, seriously, that's a good day's work.
Yeah, we're going to be talking about as well how to actually sort of decide where to look for your next commercial deal as well. So that's going to be exciting because we talk about it in resi a little bit, but we don't unpack it a lot in commercial. So let's get into quote of the week. So before I do that, any questions, comments, drop them down below. We love the likes as well on YouTube and all that sort of good thing. So what's your quote of the week, young Andrew? What are we talking?
Mate, my quote is, winning is great, but failure is a better teacher.
Is that Grant Cardone?
No, it's not Grant Cardone. I'm not sure who said it, but I felt like that was, relevant in property, because in property, you actually lose more deals than you get. So if you want to just get one deal, there's a number. And Joe's he's nodding his head going, you're damn right, we lose more deals. There's a number that you need to put out of offers to get one deal. So that might be 20 offers to get one. It might be 100 offers to get one. But there is a theoretical number that you need to actually make offers on a property to just transact one deal. And that one deal could be life-changing. And it's exactly the same with running numbers on a property. So to get good at running numbers on a property, you need to run numbers on a property hundreds and hundreds of times to be able to be confident that when you actually find that deal, that it is the right deal. Like, so it's just, property is a numbers game, and it's a lot like baseball. I used to be a semi-professional baseball player. And if you fail 7 times out of 10 in baseball as a hitter, you are a Hall of Famer. 7 times you fail. Well, no, that's not Babe Ruth, but in general, 7 times, if you're batting 300 in baseball, you are a Hall of Famer for your career. That's a massive batting average. Like, that's a good batting average. Yeah.
Good old baseball. I mean, they roided up in the 90s. So, I mean, I don't know. That's anyway.
Jose Canseco, yeah.
Bit of a,
all those guys.
Buddy Mark McGuire, I think is
Mark McGuire, yeah.
Yeah.
It's a good times. Good times.
Yeah.
Get on the gear.
But yeah, that's an interesting one, isn't it? I like it. All about learning, rather than winning is great, but learning.
Yeah, let's edit that out. Oh wait, we're live. Jeff, what is your quote of the week, mate?
Something about something with Lance Armstrong. No, so mine is, money is a terrible master, but an excellent servant, which is P.T. Barnum. P.T. Barnum sounded familiar to me when I looked this up. He was what does it mean? He was like a showman and also a politician in early days America. So, but I think that's important because we're talking about adding value, but like money is great to have, but if the only reason you're adding value is for money's sake, I think that's potentially for the wrong reason. So I think you need to, I suppose, have that kind of mindset and why you actually have a bigger why behind it, which is hopefully the finer things, like whether that be family, traveling, giving back, contributing, going all wax lyrical here. But that's my quote of the week. What's your show?
Oh, I like it. Nice little quote, mate. My quote of the week, very well thought through, just like every other week. But it is by Muhammad Ali, the butterfly, the bee. His is, don't count the days, make the days count. I think about that a lot, about when we're doing deals, because like there is literally 2-minute phone call that is the deal itself, right? Everything else up to then, but you have to show up and be ready at that point in time and actually make it happen. So you've got to, make the days count. Don't count them. Just work hard, get it done, and show up when you need to show up. That's my quote of the week. But I am excited. Andrew Bean was on our show a couple of months ago. Was it 6 months? Almost a year ago now? God, a year ago, I don't know.
Yeah.
Probably 9 months ago. I think it was in about
Have
August.
a listen to that episode. That was really, really good. It was called Cracking the Commercial Code with Andrew Bean. But this session is going to be a little bit different. It's going to be a little bit more exotic, a little bit more exciting. So anyone that is thinking about commercial property, let's dive right in. I feel like, Jeff, I've stolen your thunder here.
No, you haven't at all.
Let's go to our favorite commercial property sponsor, Steve Polisi, and then we'll jump straight into this commercial crowd.
Don't tell me he's the only one.
The amazing thing with commercial property investing is that in most cases, it's cash flow positive from day one, which means that you can drive those profits towards paying down the debt. There are instances with commercial property investing where you can actually have the property pay itself off over 10 years, which is absolutely crazy. With commercial property, you get massive net yields, so you can expect anywhere between 6 to 10%. And as we've seen in the current boom, these properties not only provide large cash flow, they do certainly grow wildly in value too. Now, with big rewards comes some risk, and this is why you should de-risk your investment as much as possible. And the way you do that is with expert due diligence. And this is why we highly recommend people hire professionals to help you along in your investing journey. Steve Polisi of Polisi Property is one such expert. Being a chartered mechanical and structural engineer in a past life, Steve draws on his analytical and mathematical skills to do that expert due diligence for you. With 6 years' experience in the space, Steve has over 1,200 property transactions under his belt. He's the guy you want in your corner, crunching the numbers and finding the best properties in the best locations, along with ensuring that you avoid the mistakes. Steve has actually even written the book on commercial property investing in Australia. And not only is it a bestseller, I believe it to be the most comprehensive in commercial property investing on the market today. He's been generous enough to give us a massive discount for our audience of 50%. So use the code OZPROP, click the link below, get a copy today, and start learning and getting on your commercial property investing journey.
And he's even got a "What would Steve do" thing going. So if you want to ask young Steve a question, drop it in there. Oh, Joe's away. I need to remove him. So, Andrew, who is the person in front? Joe's having technical difficulties, so I hear. But if you're listening to the podcast, you won't know that. But who is the person in front of us today? I was reading up about you today, and you've created and host Australia's #1 commercial property podcast, which is the Commercial Property Show. And you founded CP, which is Commercial Property Data, because acronyms need to be expanded. The first Aussie commercial property data platform to break down markets. And then we're going to be talking a lot about that as well. Interestingly, or not interesting, well, it is interesting, but I think more importantly as well, you talk a little bit about you being a dad of two, and you also you are a CrossFit junkie. I remember that photo of you and Steve sent through. I think you gave Steve a big run for his money. And you also, you're a specialist. I'd consider you a specialist in self-storage as well. But you're really, I suppose, continuously evolving and curious about how to add value in commercial property and other people's commercial property investing. So what did I miss?
Yeah, well, I was just like everyone else. Like I started with just my property journey going for residential property. And then like I just realized that residential property for me and what I wanted to do, there was a better asset class that gave me higher returns, and that was commercial property. So I basically wanted to learn more about commercial property. So I started a podcast interviewing professional property investors, basically to not only learn, but be able to share it as well. Because, you know, as everyone listening to this knows, that property is like real estate is the best asset, you know, in my mind. Real estate has made more millionaires than any other asset. There's no other asset that's safer. You know, you can look at the shares and you can debate with me all day long, but there's absolutely no way a real estate asset will ever go to zero, but a share price can go to zero from, you know, a Donald Trump tweet, you know? So like, that's the thing, is like property is the mainstay for everything that I do. And further to that, being that
not financial advice thingamajiggy that Joe normally
this is not financial advice. This
no,
is
yeah. Don't go on.
But further to that, with commercial property, drilling down further to self-storage actually is a business in a real estate asset. So it has high business returns in a real estate asset, and it's all about adding value to that asset. So the reason that I personally like self-storage, and that's what I'm doing, is because self-storage has more ways to add value to it, guaranteed ways to add value to it and to the business. And that actually results in the real estate creating huge value. So that's particularly why I've drilled down again to self-storage. But I do like a lot of different
pick up the
assets.
thread on? You said you're talking about guaranteed, sort of guaranteed. The word guaranteed concerns me in property because what does that sort of look like? Like how do
Guarantee for what? When did I say it?
Well, you said something about commercial property as a way to guarantee or something. I'm like, how does that work? Like, just run me through that quickly.
Well, I'm not exactly sure what you're referring to, but in terms of like adding value to the income of the property, that guarantees the value will change. That's 100%, like that's calculated. It's how commercial property is valued, but I don't want to give away too much before we actually get into the whole live show.
It's a good thing Joe's having technical difficulties. Otherwise, he would have been like, no, tell us now. But yeah, okay. So go on. Where are we going tonight, Andrew? I think you've prepared something previously. So
all right, no worries. I'll present my screen.
Yeah, is that where I don't know. I feel like I've jumping the gun here, but here we go. You got the
all right. Can you see my screen?
Yeah, yep. I can see it. But I think you need to probably get the whatchamacallit, get the slide share.
I am sharing the slides.
Okay. So what we see now is we see the StreamYard. So you need to, let me just talk you through this. So you probably have you got two screens? Have you got?
No, I don't have two screens, just one screen.
Maybe minimize this and it'll show. If you minimize this, it should show your slideshow, I'd say.
Okay, hang on a second.
Here we go.
Is that it?
No. I think what you might have done is I'm just trying to think. When you shared, I'm just trying to see. Joe would be able to talk you through this, but there you go. You might need to unshare and reshare. Joe, is he back? He is back.
Oh, sorry, gents. I had some technical issues. We are having technical issue day today, but I am back.
We're trying to share the slideshow. So how do you actually?
If you just hit present and then share screen, and then it will share your. You need to share. You need to go to entire screen rather than Chrome tab or window. You need to click entire screen, and then we'll see what you see. But right now,
it just says share screen, and then I go to entire screen.
Entire screen
should work.
All right. And then we'll see Yep, there we
go.
Now we can add value. Yep, now we're in Canva. Now we're presenting.
All right. Yep, Canva. I'm a Canva guy.
Here we go.
All right. So how to add value to commercial property? It's the age-old question that really hasn't been, told for a very, very long time. So it's really the thing that makes the difference between a great investment to an absolutely like home run investment. So we'll jump right in. So what's so special about commercial property? Well, I mean, it's just a real estate asset, isn't it? Like it's bricks and mortar, sheet metal and concrete. But if you actually thought that, you'd be wrong. So commercial property is actually a lifestyle asset. The way that commercial property can be put together is it actually pays for you to own it. So it pays itself off and it also pays you to own it. So it's very, very easy for a commercial property to be returning 60 to 100,000, right? So it's one of those things that you could basically retire on one commercial deal if you get it right. And that's particularly why I like commercial property, is because I can use it as a tool to fund my lifestyle as soon as possible. So the real reason why I got into commercial property, or I started chasing commercial property, I had a bit of a realization. So probably back in like 2016, 2015, I was at a event for one of the well-known buyers agents. I won't say who they are, but they're talking to me about, they're presenting their opportunity, the way that they invest. And the way that they did that, or the way that they were explaining that, was that in the first year, you'll buy one property, and in the second year, you'll buy another property. And this would keep on going for 16 years, right? So you end up buying 8 properties in total. And then after 16 years, you have almost seen 2 cycles. So in theory, speculating, that you're going to have double the amount, like capital growth, triple, it's going to be worth 4 times as much, whatever. So the first 4 properties that you bought, you would sell down and then pay off all of the mortgage for the second 4 properties. So you guys following with me?
Oh, so you're saying, if I understand correctly, you would have basically 2 portfolios, one that you'd sort of keep and then you'd sell some to pay down the debt.
Yep.
Is that where you go?
Yeah. So over a 16-year period, you're buying 8 properties. Every 2 years, you're buying one property. So after that 16 years, you have 8 properties in total. And you, like, after time, you keep on refinancing the first initial ones to fund the other ones, the later ones. And then once you get to year 16, you sell the first 4 to pay down the last 4, and you live off that passive income. So it takes you 16 years to get a theoretical, 100K passive income. So that's like $25,000 per property or whatever it was. So I'm literally because I was always about residential property, and I love residential property. I love any property. But I decided then and there that if I have to wait 16 years to try and get cash flow, why don't I just try and get cash flow straight away? Because I want to use property to be able to retire myself from my desk job that I don't like. And this is not something for everyone, because if you have a great job that's really high paying and you love that job, then buying negatively geared property might be great for you. But for me, and what I wanted to do with property, I wanted that to fund my lifestyle and be able to keep growing the portfolio. So putting myself in a negative position is actually a very, very bad idea. So
can I ask you 2 common objections to that theory about commercial property? You might be answering it in future, but can I ask it now?
Sure, ask away.
Okay. So and you've probably heard this before, it's all very cliched, but commercial property requires high deposits. That's the thing that people that are pro-resi, they say, oh, you need at least a 30% deposit. You need usually 30%. Sometimes you can get away with 20, but let's say minimum 20% and very often 30%. So then the question is, how do you fund that purchase is the objection. The other one is, I don't know what the other one is.
Let's answer that one.
Yeah, I don't know.
Let's pull a rabbit out of the hat here, Andrew. How are you going to get to that one?
So you're exactly right. There's no denying it. Commercial property has a larger barrier to entry. No one's going to pull any punches on that because it's absolutely true. But you just got to find a way. So whether or not you buy 1 or 2 resi properties, wait for that to get some appreciation and go into it that way. That's a very, very common way to get into commercial property. But what people tend to think is commercial property should be an end game, where if it cash flows and pays for you to own it, why can't it be closer to a front game rather than an end game? Because literally a commercial tenant is a very, very good tenant to have in terms of they're not going to call you when something breaks. The lease could be, 2, 3, 5 years. They're very, very committed to having a very, very good property and keeping it up and running for their particular business. So there's a lot less headaches. And I'm not saying this is easy, because it's not. I'm telling you right now, it's not bloody easy. I'm just trying to open everyone's mind. And, this is not for everyone. I'm not trying to change your mind. I'm just telling you my mind and why I actually have chosen to go down this path.
So one question I've got is how much more complex is commercial property compared to residential? Because everyone knows commercial residential. They live in it, right? Everyone owns one. They rent it. They understand it. But commercial property is a little bit more. It's a little bit farther to grasp. But I think that's half the reason why people are not interested in commercial properties, because they're just like, oh, well, that's too far away from my mind. I've never rented one or gone to one. I've gone into them, but But yeah,
I'd probably say 80%, Joe, because the things we don't understand, we often just steer away from because it's like a primal instinct to not primal. That's a weird kind of way to put it. But you know what I mean? Like it's to say, oh, look, if I don't understand something, if I'm going to get eaten by that tiger over there, so I'm going to stick to something I know and I trust. But yeah, go on, answer the question.
Tell you the truth, it's a false belief that commercial property is actually harder than residential property. It's actually easier. 100% easier because I can calculate it to the dollar. 100%. I can calculate it to the dollar, the value. So it comes from a different lens, yes. But as soon as you understand the calculations and the way that it's valued, and you're going to understand that exactly in 3 slides, you're going to realize that, commercial property isn't that hard. It's just something that's been built up in your mind that makes you feel that it's harder. But because you're used to living in a residential property. But
can we throw an objection at you? Another objection?
Sure. Hang on. I just want to finish this thought. Hang on. I just want to finish this thought. So if you're looking at a residential property and a commercial property in the same hands, it's a lot more difficult to understand and calculate the exact value of that residential property because there's so many different factors at play. Like people just want it more. They have more money than you. There's heartstrings. They fall in love with the property. But commercial property is all done on a calculation. Like you can literally calculate to the T what the property value is. And you don't fall in love with a warehouse. You're only doing it for a financial benefit. So in my mind, that makes it easier to buy and sell commercial property because you can calculate exactly to the T how much it's worth. And there's no speculation. There's nothing like that. What was your question, Joe?
It was me. I just said, what happens when biz goes down? Well, the business goes down and tenants wants out with a 4 year still on the lease. Thanks, Ross. Love your work, by the way.
Yeah, that can happen. It definitely can happen. But, residential properties can go vacant too. But if you're buying the right property in the right location, a lot of industrial property now have waiting lists in areas. Like industrial property has never had better fundamentals and tighter vacancy in Australia than it does today. So like if you're buying the right property, yes, there are sectors of commercial property and they're different. So retail sector is different to an office sector, is different to an industrial sector, is different to specialty assets. So yes, there are some assets that have prolonged vacancy, especially if you get the location wrong and the sector wrong. But right now, I'm telling you, industrial property has never, ever been a better asset to buy that is safer. You have waiting lists, and you can reference this to Steve. He'll back me up 100%. There are waiting lists with agents to get into these properties. So if there's a waiting list,
commercial properties,
industrial warehouse, yeah, 100%. Because in Australia, overall, industrial property is undersupplied. Because if you're looking at it from a council perspective, they don't want to have large industrial land rezoned for industry to come in. There are parts of Australia that are more industrial, like Newcastle is quite industrial. There's a lot of big industrial, older factories and things like that there. But in terms of a council, the dominant idea is to bring residents in and make it great for the residents. But they still need that industrial zoning to service people. So that there's a scarcity that's built into industrial property, which is really, really great for, investors going forward today.
Yeah, super interesting. That's such a great point because at the core of it, residential real estate is the balance of supply and demand. But when you talk about industrial, there's only an industrial estate that exists. The rest is residential surrounding it. They can't build any more industrial. So
that's right.
Same rules would apply.
That's right. So Stevie and I did a top 10 list last week. And
what if they change the zoning though? Can I ask?
They can change the zoning, but if you're already zoned residential and there are houses there and you're baked in like supply, and then there's demand there from the residential properties, it's very, very hard to rezone it. You have to go outside of the area. So what I was saying was Stevie and I did a top 10 list the other week. And we didn't actually do this purposely, but I think it was 9 out of the 10 areas were actually coastal. So the best industrial areas are actually coastal, and on one side there's beach and water. You can't go that way, so you have to go back, and the rest is residential property. So you got baked in like supply issues there, which is great for being an industrial property investor.
So what is that what drew you to Coffs Harbour, like that fundamental, or are there other fundamentals?
Coffs Harbour is one of the best markets for tightness, like for like low vacancies in Australia. It was actually the second best market in Australia for vacancy for industrial property, and we were only doing industrial property. We weren't doing all the sectors, but just opportunity there. So I like areas that are away from capital cities, so you get higher yields and less demand from, or less like attention from most investors. So I've got a self-storage project, a client project in Foster. The client has two facilities there that I'm helping them improve the facility, the business, and make it all, really automated and things like that, putting in pin pads and gates and surveillance and bringing them onto a self-storage management system. So it's been a really, really great project. And I drove up to Foster, and Foster has absolutely no industrial property for rent. So like if you're going into that market and you're buying an industrial property there and there's no other property for rent, is that safer than going into a capital market or a capital city market where there's always lots of like supply, but there's always lots of demand, but the supply and demand ratio is way looser than a supply and demand ratio in a smaller market. So that's what you kind of have to look at, is the supply and demand ratio in the right, for what you want to do with your investment.
How over how long do you track that demand and supply ratio though? Because how long has it been like that for?
Well, CP data I've been collecting about 4,000 data points on, all commercial markets in Australia for about 2.5 years. So there's trending lines that you can see in CP data. And that's basically markets that have 20,000 in population or more that we track in CP data. So it's not every single market in Australia, but if you have 20,000 in population, then more than likely we track it in CP data. So it's a 12-month graph that is always displayed in CP data that's rolling. And you can the data tells you, like, the data doesn't lie. Like it just is. Like there's no manipulation. It's just the data is what it is. Whether it's good or bad, we post it. So
what about boots? I mean, to young Joe, what about boots on the ground? What sort of? I mean, we're jumping all over the place here. I like it, but what sort of stuff when you're visiting a location? Because it sounds like you do. What kind of checks and balances do you do in from a boots on the ground perspective in certain locations you're buying in?
Joe?
No, he's not talking to me.
I'm talking about for commercial property.
He's talking to you.
You're talking to me. Sorry,
Joe talked about. Yeah. What do you
talk about?
So you're asking about what boots on the ground a lot. What boots on the ground?
It sounds like you're doing that.
Oh yeah, 100%. Like you're going, particularly with self-storage, because this is a self-storage deal that I'm looking at. You're looking for, traffic flow and different times of the day. You're looking at like what's actually happening in the area. Because a Google walk, like what you would usually do is you do a Google map walkthrough first to understand the area, but then being in the car and driving through it is totally different. So when I was in Coffs Harbour on Monday, I'm seeing residential development here, there, it's going crazy. There's things happening. I'm at like one of the because in Coffs Harbour, there's these beautiful beaches, like little beach towns everywhere. So I sat down and had a lunch at a cafe, and it was buzzing, absolutely buzzing. And I said to the lady, like, is it usually this busy? And she's like, actually, it's pretty quiet today. And like, it was pumping, like there was at least 40 patrons like having lunch at the time. And I said, are these people, because there was a caravan park that was closed. Coffs Harbour is very good for like people coming and having a holiday. So there is obviously some touristy kind of, aspect to it. And she said, no, it's probably like 50% tourists and 50% locals. Like we're always really pumping. And this today was actually quiet. And like also from like a lifestyle perspective, I really like areas now that I could see myself living in. So if I want to live there, there's chances are that other people want to live there. So if more people want to live there because of the working from home movement, which we also track in CP data, they're more likely that commercial properties and businesses in that area are going to get a boost. So that's including residential. Like residential is really the key to commercial property, and commercial property markets or assets tailwind behind residential. If there's no residential, then commercial markets don't work. You can't just throw
such a good point.
You can't. It's just like riding in the tailwind. Like if you're a cyclist riding in the slipstream or whatever they call it. That's what commercial property does.
That's interesting because like that's 100% true. I mean, you run a data company, and data only gets you so far, but it's getting boots on the ground that allows you to understand like how many people are actually going up to the shops. Are the shops shutting down? Like, is there no one available? So from a commercial standpoint, do you look out for, because you were saying there was a development there and a development there. Is that a good signal for how commercial property is doing, what the residential development space is doing? Because all of a sudden there's one place getting knocked down, put into three, and then another three. And then all of a sudden there's a lot more people there. Is that what you're kind of looking out for? Like,
100%. Yeah, I want to see population growth in the market. So not only, and population doesn't necessarily always make commercial property better, but it's a good thing to have. I would rather have it than not. Jobs in the area is also a big thing as well. So in CP data, we track jobs for all markets as well, because you know what happened in Perth when the mining boom, markets there went crazy. And that was because there was so much demand from people being there because of the jobs that were available there. But when the mines shut down, the whole thing turned around and Perth was stagnant for years. So jobs is a very, very good indicator. And also another thing to look for is also infrastructure. And I'm sure people know that. But Steve and I also touched on infrastructure as well. And Steve went through a whole list of infrastructure in all different areas around Australia. But these are all things that are just ticks. Like there's no one metric that you can say, because of this is going to happen. It has to be a body of data, of information, of boots in the ground to really understand the market. No one metric is the be all and end all. And that's just how it is.
I want to take one step back because I feel like we've somewhat put the horse before the cart.
Back.
Yeah, take a step back. Because let's just say I'm interested in commercial and okay, so great of it. And how do I actually know where I should be looking before I even
that's where CP data comes in. So it's really a tool to give you an idea of what location is a good location for you and the metrics that you want to look for. And then you can kind of nail it down from there. So the way that I built CP data for myself to be able to understand markets quickly. So the problem that I had was that I would find a property that looked good fundamentally, like at the actual property level. So it had good return, it had a good tenant, it had a good site, like things I could do with it. But realistically, then the next day, 2-3 days a week was me researching the market to make sure the market fundamentals were good, because you can find a great asset in a shitty market, but the market is really what makes you. Whether it's a good market or a bad market, the market will always win.
So what are some indications? Let's say we don't have access to CP data, and obviously you can get a subscription, but let's say we decided against that for whatever reason. What are some of the things we can look at for ourselves for some good indicators?
I would go onto all the listing portals and look what's for lease. So that's a really good indicator of what's possible in the market. So there's nothing for lease for the type of property that you're looking for. That's great. And you can actually look at historically what's been leased as well. So you could find out what has been leased in the market, and you could find out what it's been leased for. So you can figure out the rate per square meter as well. The listing portals are actually a very untapped resource. And this is where the data comes from for CP data, is all of the listing portals. So I'm tapping into that data and collecting the data every single month, literally like 4,000 data points, putting it into
what data are you pulling from the listing website? What data could I use from the listing portal as a not no one that knows how to code? What would I be pulling out? Like, what would I be?
Well, you don't need to know how to code. You just need to understand how many properties are for sale, how many are for lease, how many are leased, and how many are sold. Like these are the metrics that we can use. Looking at getting that data and collecting it for 1 month won't teach you anything. But if you do it over 2.5 years, when you have a body of data like that to have a trend, this is what CP data is. And so those particular metrics are put into a dashboard style spreadsheet, and then they calculate the different numbers to make an easy way to look at a market within like 5 minutes. I can tell whether it's a market that I want to go into or not.
Yeah. So it's more about a longer term trend about keeping on top of that market. Actually, a question I have is, let's say I want to buy my own commercial property. What is the minimum amount of time that I should be spending doing some research and due diligence on an area before I dive headfirst into it?
Well, it's really how long is a piece of string? Did you live there? Do you know the market already? Do you already understand the market? If you feel like you've got a handle on it, then maybe you do. But if you're going into a market and you've done 1 day's research, then I'd probably say to, keep on looking and understand what's been happening in that market. Like it's depending on your experience in that market, would give me the answer. But if you don't know the market, you don't know the market. And if you don't know the market, you don't know what you're buying, then chances are you're buying an overpriced property.
How much credence do you pay and look at sort of previous sort of sales in an area?
A lot actually. Like if it's an asset that I'm looking at that is potentially a similar asset, like for like, and tenant for tenant with lease for lease, then that could potentially be a very, very good indicator. And like with commercial property, it's valued is the main idea on how we can actually add value to it. So the real power of commercial property, which is in the next slide, is how like it is valued. So to understand how to add value, you need to first understand how it is valued. So this is a really big key of commercial property, where the power is in the capitalization rate. So if it wasn't traded on a cap rate, then commercial property wouldn't be the asset that it is. But because commercial property is traded on a cap rate, with the income being the driving force of value, this is the power of commercial property. So every single dollar that you add to income, to net income of that property, increases the value. And that's not speculation. That is 100% like you can calculate that. That's how they are valued. And there's no like saying, oh, actually, it's actually valued this. It 100%, if I add value, as in add income to the property, the value of the property will go up. It cannot go anywhere else but up. And that's the power of commercial property.
Simple as that.
Simple as that. It's simple. I tell you right now, it's a very, very simple game.
So one thing is an under-rented asset, right? So let's say, I mean, I come across this all the time, where there's a property that may be, like, for instance, the owner occupies, I think it's about, don't quote me on the number, about 65% of the residential market is owner occupiers, or it might even be 70, 80%. I need to double check that number. Do you know
71.285761, isn't it, Joe?
Ooh, good. But they're the ones that are kind of driving the value. So if a property has a lease already on it, right, they have a 12-month lease, that asset will typically sell for less, because all of a sudden 70% of the market are not interested in it. It's only investors. So you can actually buy that property that's rented. Typically it'll be under rented. So instead of getting $500 a week, it'll be getting $400 a week. Does that thing kind of exist in the commercial space, where you can just buy a place and say, hey, actually the rent's super low. How do we, increase it? Let's throw an extra $1,000 a month.
This is how simple commercial property is. This is part of the value add formula. So finding under rented property is literally the best way to add value to commercial property, because, and this is what I was getting to you, Joe, in that post that I on Facebook, when you asked how much money have you put in to make this amount of money. And so I've seen people find under-rented property. They've increased the rates over time, and this property might need a little bit of work, or it could just be like the lease is month to month. So all you need to do is redo the lease with the tenant, bringing the rate per square meter up to the actual market rate. And that could be wildly like huge. That could be like $30 a meter. And that doesn't sound like much. But later on in this webinar, I'm going to show you exactly how much increasing the value from $30 per square meter can change the value of the property dramatically. And this is really the best way to do it, because it costs you no money to have the knowledge to identify a property that's under rented. It costs you nothing. And then you can just, with a stroke of a pen, you can literally add hundreds of thousands of dollars to the property. That's a great asset to me. That's a great deal. Like that's a very, very good way to do things. So if you just get good at doing this one thing, finding under rented property, there's no limit to how much money you can make and how much wealth you can have. You've just got to have the knowledge and the vision to be able to see it.
How hard is it to find?
Someone's jumped in. Under-rented ugly ducklings are where the real profits live, mate. I think you've converted one of them already. That was quick.
There's a saying in property: the more problems you can find, the more money you can make, and that's 100% true. So typically with a commercial property, they're ugly. They're not beautiful. No one's cares about how it looks, but the ugliest property can be so ridiculously valuable because of the lease that's on it, that it doesn't matter that it's an ugly duckling, as long as it works for the tenant or the business that you are trying to attract or you've got in there, then it doesn't matter if it's a rundown warehouse. Like, I don't know if you guys have ever, worked in a warehouse or anything, but these places aren't tidy. They're literally working in them. They've got, forklifts going in and out. I've spent a lot of my years in warehouses, so they're not like beautiful, pristine places like, a big tall office tower. This could be an industrial property that, a mechanic is using. And it could be the ugliest, most rundown junk of a piece of property, but it could be worth millions of dollars just because of the lease and the return that you can get from the property.
So what are some of the, I was going to ask, what are some of the shortcomings of commercial property? Because I feel like we're only talking largely here about I think I know the answer to it. Let's go. So
there are lots of shortcomings with commercial property, particularly vacancy. It's the biggest risk with commercial property, and it is a real risk. 100%. No one's going to lie about that. Properties can go vacant for a long time if you get it wrong. But the good thing what happens when it goes vacant is you might have been getting a great return for a long time. So if it goes vacant for 6 months, you can potentially then raise the rates to actually make your property more valuable after you get a tenant. And you can do a little bit of a refurbishment. You could section off a little bit of space to get more rent. There's 6 months in a life cycle of a commercial property is very, very short. Like with commercial property, you need to have buffers in place. You need to have a strategy of a buffer to make sure that you can handle the interest repayments, because no one has ever lost a property that has huge cash flow. No one's ever gone bankrupt with a property that's actually been cash flowing forever and a day. Markets go up and down, but cash flow always remains. So if you're looking at it from that perspective and you're banking cash flow and you've got 6 months to 12 months of interest repayments in your bank, and you can have multiple properties too. So if one goes vacant, the other one is supporting the other one. There are lots of different ways to do it, but prolonged vacancy is the biggest danger in commercial property. And this is specifically why I like self-storage. It's 100% almost impossible to ever have a completely vacant self-storage facility. The more tenants you have, the more tenants. So if I have 100 tenants, right, and 10 of them leave, which is a lot, I've still got 90 other tenants to pay the bills. I might have to go down to only 40 tenants to just be breaking even. And that's so ridiculous that you would think that, 60 tenants could move out in 1 week. It's just,
That's easy, by
it's
the
a
way.
constant churn of people going in, people going out, people going in. So it really, the way that I look at it is who is in line next to pay the mortgage. And the biggest risk about commercial property is single tenancy and vacancy. So if you're the next in line to actually pay the mortgage, then maybe that property is a little bit more risky. And that's why, for me, self-storage is the asset of choice, because I have 150, 100, 100, 250 tenants, in line to pay the mortgage for me before it gets to me. Just that for me removes the risk.
Yeah, I like that. One thing I need to say, Joe and Andrew, someone's written here, Joe and Andrew's voices sound very similar. So this is Joe speaking right now. Can we just wheel it back? Because I know there's a lot of people in this group that love commercial property. There are also people that are brand new to commercial property. So I saw something here that's talking about cap rates. Can you just break it down for us? So for those that don't know, what is a cap rate? How do we value commercial property, and what does it look like?
Yep. So to understand how to add value to a commercial property, you need to first understand how it is valued. So a cap rate is a perceived return and risk in a market that the investors are willing to accept. So say if I'm investing in a capital city, say Sydney, and I'm buying a industrial property, the return on that property might be traded at a 3 cap. So that's like 3% return on the total value of the property. And that's because an investor is perceiving the capital city of Sydney to be a more sure thing, to make sure that they actually will get a return. But if I'm going into a more regional market, I have to get a higher return for the risk that I'm potentially taking in that market. So in terms of a cap rate, it is a reflection of return and risk, a perceived return and risk. It is definitely perceived, because a market, particularly agents and investors, will, and definitely in like the commercial boom where we just went through, where interest rates were getting so low, that returns were so good that people were like willing to have sharper cap rates. So that means if a cap rate goes down, the value of the property goes up. It's counterintuitive. And a cap rate goes up, the higher the number, the lower the value is. So it's counterintuitive. It's actually quite hard to get your head around. But if you're going,
it's like a seesaw.
Yeah.
So it's super confusing. Like if I was to explain it simply, I guess it would be just, it's dividing the property's yearly income by how much it costs to buy the property. So if the property makes $50,000 a year and costs $500,000 to buy, the cap rate would be 10%. It would be the amount of money that makes divided by the 500,000, which would be your 10%.
That's right. And a 10 cap would reflect higher risk in a market. So if I'm, say, going into like Townsville, I'm going to be demanding a good 7 cap for an industrial property there with a decent tenant. If that property was the same and that tenancy was the same, like the lease, and you picked it up and you moved it into, say, Brisbane or a Sydney, you would be asking for like a 5 cap. So that's where, if all things are the same, the actual geographical place where it is at, it determines the risk and the return that the investor has to have to take that risk to go into that market. And that's
the thing that I've trying to wrap my head around sometimes, because obviously as the rent goes up, like in Townsville, for example, 7% cap rate. If the rent was to go up, then the cap rate's going to go down. So why wouldn't people just say, oh, I suppose actually people would pay more, because like what sets that 7%? Like, why do people
why, if the income goes up, why does the cap rate go down? You're talking about yield.
I suppose that's the question. Like, why doesn't the
there's a big difference between cap rate and yield. So a cap rate is only used in context of buying and selling. Once you've bought the property and if you're selling the property, then you're actually getting a yield. So in Australia, unfortunately, agents and investors, they use cap rate and yield hand in hand, but there is a difference to the actual definition of the word. So a capitalization rate is the actual percentage that you're using to divide the net income to come to a value of the price. But then once you own that property, you're getting a yield, a return. So if the income goes up, your yield will go up, but that doesn't mean that cap rate goes up, because the cap rate is the market. It's not the actual yield. So the cap rate is determined by the investors and people in the market with what they're willing to accept as a return. Your yield might be through the roof. It could be a 10 cap, but when you go and sell that property, you'd still be selling it at a 7 cap. So you would just have huge value in that property because you've increased the income, but you're still selling it at the same market cap rate. That's the big difference.
I suppose that was my question. Like, who actually, like, obviously it's supply and demand. Like, how many people want to buy a certain asset versus what the supply of it is, I imagine.
100%. Yeah. So a lot of the times the agent will kind of determine what the cap rate is, and then they'll get offers and expressions of interest from the investors, and the investor will then give them an answer whether that cap rate was fair or they're willing to actually go through with it. So like a lot of the time what's been happening is that agents are always wanting to sell property for higher prices. That's their job. So they'll always push the envelope, and investors will always push back saying, no, this is what it needs to be. But then when FOMO gets in play and there's more like lower interest rates, people then say to themselves, well, I'm actually okay with taking a lower return. And that's what drives capital growth in commercial property. It's not anything to do with like, real market forces, as in like residential. It's different to residential. It's your perceived accepted return. So right now, there are less buyers in the markets for commercial property. So theoretically, cap rates will either stay the same or soften. And that's a good thing. Like right now, we're actually in a normal market. We've been in a crazy, like out of this world boom market for too long, and that's not normal. But having a 5% like interest rate or a 6% interest rate on a property is actually more normal than anything else, because on average, the interest rates have actually been around there over time. So right now is actually the best time, and I like right now, because now more people are fearful, and when people are fearful, you should be greedy. So there are a lot of properties right now that prior to the interest rates rises, they would have been getting gobbled up straight away, no chance at ever getting in. But now, like there are a lot of like 6 caps, 6.5 caps that are being listed. So previously, when before the mini boom, trying to get a 6 cap was hard. If you could get a 6 cap, you were doing really well for probably about 12 months to 18 months. Prior to that year, it was a 7 cap. If you could get it, you wanted to get a 7 cap, people were actually trading things on like a 6.5 cap, and it was slowly going down because the perceived accepted return was changing. And this is just on average. Like, obviously there are markets within markets that are different, but the perceived accepted return was changing. So if the further you go out, like if you look at like some of the old like training material from like James Dawson's course, who I highly recommend, like he's talking about 8 caps or 9 caps, and like realistically it's so out of date because it's just you couldn't find that kind of property right now. But like now things are turning on different sectors. So there are different sectors that are doing very well, like industrial property is still doing very, very well, although you can have a bit more wiggle room with the pricing now and more better. Like you could put in a bit more due diligence time on your days for due diligence and still get a good look at it. But before it just, you didn't get a look in. Like if you had any kind of due diligence period and you wanted a 6 cap, there was no, they'll just move to the next offer.
So I guess, how low can these caps go? What I was reading a book by George Antone, I think it's called The Wealthy Code or something like that. And he said the value of commercial real estate really is the spread the spread between what the capitalization rate is and the interest rate that you're paying. So if you're paying a 5% interest rate and you're getting a 7% return on your cap rate, then you've got the spread. You've got a 2% spread. But when those start to compress, like, then you're not really making money. What's the point of being involved in the project? How low can these things go?
That's exactly right. Like, we're only doing this to make money. If you can't make money with a commercial property deal, then there's no real reason to do it unless there is some huge value add like development or something like that where you can force huge value on the property. And that's what I'm talking about with adding value. I'm forcing value. I'm not speculating. There's absolutely no speculation in this. And I'm coming in with a value add strategy plan when you're buying the asset. So the big difference between a mum and dad investor and a professional investor, and this is what I've learned from interviewing many professional investors on my podcast, is that a professional investor comes in with a plan in place to force value. They recycle the cash and they use the same money to buy a new property while still holding the other property, and they build wealth that way. Whereas a mum and dad investor, they buy it with no plan in place, they think it's set and forget, and then there's no real strategy to move on. So it's a big difference in mind shift. And that's why CP data exists. So mum and dad investors can have the tools and, data to be able to find a under rented property, to be able to find a tight market that has really good vacancy or really low vacancy. And this is what, Steve and I have been beating the drum on for a long time.
Yeah, I love that. Okay, well, let's dive into the next little topic you've got there on the slides. But before we do that, let's jump into our sponsor. This live session is sponsored by Scott Agate from Hello House. Scott has created the world's first property negotiation as a service business. So what does that mean? Well, let's think about it. When was the last time you negotiated on anything over $100, let alone a property that is going to be one of the biggest investments of your life? The vendor, they have a trained negotiator on their side in the form of a real estate agent. That's kind of like you stepping into the ring with Mike Tyson after never training a day of boxing in your life. These guys are trained professionals, and that's what they do day in and day out. And this is what Hello House does every single day as well. They negotiate on property to get the best buy price from the real estate agents. Scott Agate, he's the expert negotiator. He has been in this industry since 1995. He owned and operated 3 Bell franchises. Scott was the guy that was teaching these real estate agents all these agent games. He knows all of their tricks. Having him on your side is going to give you a massive unfair advantage and literally save you tens of thousands of dollars. Unlike other ways of purchasing property, Scott's incentives are aligned with you, the buyer, meaning the more money he saves you, the more money he makes, which is what you want. You need to have those incentives aligned. Scott has kindly offered our group a massive discount on the retainer fee for his service. So if you're looking to buy your next home or investment property, click the link below to get in touch.
I think we changed that link to the get buy ready, but maybe I got the wrong link. But anyway, there is absolute value in that. So speaking of value, what is the main value driver in commercial property? I imagine this is for, or is it self-storage? Like which type of value driver are we talking about?
I'm talking for commercial property, which is also self-storage is also commercial property. It's just a different class of asset. So the main driver the main value driver in commercial property is the net income. If you can increase the net income, then you can increase the value. It's literally that simple. So if it's that simple, all you need to do is figure out how to increase the income, because every single dollar counts. Like literally, if you can add, say, $5,000 of income, net income to that property, I'm going to show you shortly how much that'll actually translate into value. Like it's absolutely mind-boggling how much value you could add by just adding $5,000 or even just adding $30 to the rate per square meter. Like, and that's not $30 is just a number. It could be $10, it could be $5, it could be $20. It's anything. Adding any dollar to the net income increases the value, guaranteed. No money, no back money, like guaranteed, like no questions asked. It's
so
just
when
that
we're looking
simple.
at these value add deals, are we specifically looking for deals that have their lease coming up for renewal pretty soon? Like
No, it doesn't have to be.
Because if you've got a deal that's got a lease that's, CPI adjusted over the next 5 years at a set rate, you probably don't want to add value to a property like that because you wouldn't be able to get your return. So, I mean, how do you think about that?
It doesn't have to be a lease that's coming short. It could be a tenancy that's having a market review very, very soon. So not all rate increases are CPI. It could be fixed. But every now and then in your rate increases, you will have a market review. So that can be good or bad. Because if you bought a property and the rate per square meter is too high, guess what? That actual rate is coming down to the market. So you need to make sure when you're buying a property that the rate per square meter is fair. And what I like to talk about, or what I would, enforce or talk about, is that you should try and not push the envelope so it's way over the market, because eventually that is actually going to have to come back. And then, you're going to be losing money on the value of the property. And also the tenant will look elsewhere because they'll think, well, I'm paying this here, where I can go over to this property. It's exactly the same, and they're only charging me X, and it's a lot lower than, what I'm charging here. So being commercial property, the tenant is your partner. If the tenant has lots of success, you will have lots of success, and you need to make it easy for them to have success in commercial property. So working with them, and I'm not saying like undercutting yourself, it has to be fair, but you don't want to really go crazy and push the envelope like you can in self-storage on your commercial property lease. In self-storage, it's different because I'm trying to find the highest paying customer possible, and it depends on your need. So if you really need self-storage and there's nowhere else to put your stuff, and I'm charging you $50 more than the market because you need it, you might still pay it. So self-storage is a lot more cutthroat.
A lot more savage, where you can just, you get a new replacement person in. So in terms of value add strategies, what are some of the things that drive value? What are some of these strategies? What drives net income more than anything else? Look at this. It's like he's prepared this.
So what if income is the thing that drives value, what drives net income more than anything else? So I want to jump back to you guys just for a guess. What would you guess the next slide will say?
Rent is going to be fundamental, and interest rates.
The net income is the rent. The net income is the rent. So guess again.
Well, I feel like I won it already. That's fine. Okay.
Jeff, what do you got?
I was going to say maybe the demand for the asset, perhaps from a tenant perspective.
It's a good guess. Both are, I'm not going to say wrong, but just not correct. So the biggest thing that drives the net income is actually the NLA, net lettable area. If you can increase the net lettable area or raise the rates, you have then increased the net income, which increases value. So say it with me, guys. Increase the NLA to increase the net income to increase the value. That's the flow and effect of increasing NLA. This is the simplest thing you could ever think of. Like this doesn't happen in residential property. Like you could put in a great kitchen, you could put in a great bathroom. At the end of the day, the comparables are what is going to actually value that property. You can't really calculate it. But if I increase the net, you could
develop it though, couldn't you? So you could increase the area that you're renting out separately.
Yeah, but that's that's literally what I was just about to talk to. Is I have people that are like, you know what, I'm going to build a granny flat, and because I need to increase the rent. They then have a $500,000 asset. They spend $200,000 on a granny flat, and that gives them a great rental return. But they then expect their property to be revalued at $700,000 because I've got 500, I spent 200, but it comes back at 600,000 because the banks don't value it as much as that.
So in commercial property, that's where it's different. This is the power of commercial property. The game, it's a different game. So if you increase the net lettable area by a little amount, it doesn't have to be big, then you're actually going to rent that space out. You're going to get more net income, which increases the value. It's just a flow-on effect. It's literally that simple. So if you increase
it's just the utilization of the asset. How do I make? There's this big al fresco area out the back. I've got a great little storage area here, but it's just it's not being used. So what you're saying is I should be putting more units at the back, which will then give me a more lettable area and allow me to raise the rent.
100%.
I want to. Oh, sorry, we'll get to that one. But
So basically, in the simplest form, if you have a piece of land or you have a property and there is some space that you're not getting any rent from, like I've got one of my clients that has exactly this type of asset. So it's an industrial property and there's a space at the back that neither of the tenants are using. Literally all we're doing, because we can't build on the actual site because of regulations with flood zones and stuff, but literally all we're doing is we're putting a gate around it and we're turning it into hardstand. So we're going to be getting about $10,000 to $15,000 extra per year in net income. And that is a huge value add. So what I do is like hardstand's just like a area where people might store stuff. So like a lot of businesses might have equipment like a, like a little mini tractor thing, like a little dingo or like anything they could put down because they don't want to take that home with them, but they might be working in a residential area that they need to service. So they'll put it into like storage, or they might have a gated hardstand that they just go in every day and take the equipment out. And that's like just the simplest form. Like, do you guys think that it's easy to get a gate constructed?
And that adds to your net lettable area.
Yeah. And then all you have to do is rent it out to the tenant. So in terms, now you've got another tenant, which is another source of income. So you've increased the net lettable area in terms of actually getting rent out of it. You haven't increased the gross floor area, which is different. The net lettable area, because you're making income from it, is now like an asset to you. And that adds value to the property as well. So like, it's just that easy. I can't like explain it any easier than that form. Increase the NLA, increases the net income, and it increases the value. If you can look at all property through that lens,
getting somewhere.
If you can look at all property through that lens, you can do very, very well as a commercial property investor. And this isn't taking into account a lease at all.
This is what Ross is asking about here. So, is that what you're saying? So you can divide, you can put it in terms of hard stand at the back. Is that dividing the NLA, which increases the net income? Is that what you're talking about, or is it different?
No. So like you say you have a property and you have a yard area, and the tenants that you have on the property aren't using the yard area. It's not leased to them. It's just dead space that you're just paying council rates for. Kind of thing. Yeah. Okay. So then this is just one value add driver. This isn't the be all and end all. You could put a shed there. You could do all kinds of stuff. But particularly for one of my clients' properties, I basically just had the idea, well, let's just gate it off and rent it out as hard stand. Because as I've been saying, every dollar counts in commercial property. It's valued with a cap rate, which is capitalized from the net income. So if we can increase the net income from increasing the NLA, we increase the value.
Well, I think what Ross is talking about here is, can dividing the NLA also help with net income? I think what he's meaning is cutting the place up into multiple pieces.
Putting a partition down the middle, maybe.
Yep.
Yeah, exactly. You've got an office space.
Yep. Yeah. So the next slide, I'm going through to my top 6 easiest value add strategies. And that may, I don't want to ruin it, but that may get a sneaky peek in there. Okay.
I listened to your podcast where you spoke about, like, you went from the easiest to the hardest ones.
Yeah. So I've whittled that down again to literally the easiest ones that, blind Freddie could, figure out and see himself. So,
or Francine.
All right. So if the main value driver is income and NLA, then how the hell do I add value to commercial property? Well, you guys are in luck, because here is my top 6 easiest value add strategies. Seriously, you cannot go wrong. It is literally that easy.
I'm
No
a little
way.
worried when somebody says something. Yeah, like
you really pumped that up to make me not believe you. But
That's good.
I want to
That's
be
good.
fooled.
That's
I want to
good.
be
That's
believed.
good. Come at me.
Yeah.
Come at me. All right. So here we go. So this is exactly what I think it was Ross said. So the first one is split the property into multiple tenancies if you have multiple roller doors. So think about an industrial warehouse where there are multiple roller doors, there are multiple access points. If you've got one large tenant, so say you have a tenancy that's month to month and you want to move them, they don't need that much space. They could possibly do it in a smaller space. If you can put up a partition wall, and we're not strata titling this because then you'd have to do all fireproofing and all kinds of stuff. If you just put up a partitioning wall and you reduce the net lettable area, then the rate per square meter that has to be paid to you goes up. So that in turn creates value in the property. And that's a very, very good strategy. And that's actually the hardest strategy on my easiest list. So if you can't do that, then you've probably got problems. But so
what are some of the things that we need to consider? Like you can't just put a wall up. What are some things to consider if we are thinking about this strategy? We found a commercial
Does it have
property.
to be council approved, or like what's
not if it's internal and you're not strata titling it. It doesn't have to be council approved. You could petition off a section of a property and rent it out. 100%.
Resi.
Give that a caveat to check with your council, council permitting, but it is a very, very good strategy because
council permitting if you tell them.
You don't have to tell them. But so if in terms of a commercial property, the larger the space, usually the lower the rate per square meter. So when you're splitting up and dividing into smaller spaces, the rate per square meter goes up, which creates more income for you, which creates a huge value add. Very, very powerful strategy.
What are some of the risks of this strategy? What are some of the things we should have for consideration thinking around this one?
Risks of it. Well, I mean, there's not much that really comes to my mind because you're putting in another tenant. So you have multiple tenancies, which is great because then you've got one more person in front of that conga line. That's who's going to pay the mortgage. So that's a plus. You're getting more rent. The only probably thing that I would say that could be a risk is that when you're reducing the space, the type of tenant that you will probably attract will probably be a lower quality tenant, as in the business will either boom or fail. So that tenant might only stay for 1 or 2 years. So you might have higher tenancy turnover, but I couldn't say that hand on heart saying that is actually going to happen. So it really comes down case by case. But if you're looking to add value to the property, then this is an excellent strategy, and it doesn't take too much money to actually split up a tenancy, rewrite a few leases, and Bob's your auntie's brother. You got value there.
Yeah, because one of my considerations would be if you get a little bit greedy, right, and a space that you can split into 2, you decide to split into 3, and all of a sudden 3 people are not interested in it, and neither are 2 people, and you kind of go too far gone, and you make it too small.
So what you would do is and this is what I do, quite a lot, is I ring the agent and ask what the demand is for this type of space. If they say to me, oh my God, there's a waiting list, we can never get anyone in that space. If you have one, let me know. Then I'm pretty confident, and that's a great strategy, bringing the space smaller. And literally ring every single agent in the market that's trying to lease these types of properties. The more people you can talk to, the better data, the bigger pool of information you can get, the better off you'll be. Don't ever do something. It's with any property. Don't do something without first understanding the demand for that type of asset. That'd just be stupid.
Yeah.
And are we going to real estate agents, property managers in the commercial space? Are they the same thing? How does that kind of work?
They can be the same thing. Property managers are people you want to go to first because they are actually managing the properties and they should know. You'll be able to get a good understanding of the rate per square meter for this type of space as well. That'd be a good idea. Then you would also go to selling agents because they, potentially you could just be splitting this up, putting 2 tenants in it instead of 1, and then flipping it back onto the market and selling it for a huge profit. So you might actually find first the managing agent you're talking to that there's a demand, we could do this, the rate per square meter is going to be this, their property will then be valued this. Once you actually do that and you have a tenant in place, then you would, like, after you've already spoken to the selling agent, you would say, okay, well, I've done this. I've got this asset with these leases, with these tenants. How much can I get for it? Is there demand for that? And if there is, and you want to sell the property, then great. Or you might want to refinance it. Great too. So there's not too much downside with this strategy if you're smart, and you don't really need to be too smart to figure it out. So we'll go on to number 2. So close in an open space to create more NLA and start charging rent for it. So you can see there is a common theme.
Is that the hard yard thing? Or?
This is, so it could be a hardstand. It could be anything. So I actually saw this strategy done at my CrossFit gym. So they had a roller door at the front and a roller door going through to this backyard that was totally unusable. It was totally not undercover or anything. And all they did was they already had the one wall there with it opening like a roller door. And they just put 3 walls and a roof up. And then, hey, Bob, it's NLA that they need to charge for. So they literally created about 100 square meters of net lettable area.
Who did they rent it to though? Like who's renting that? Like just
the gym tenant is renting it, and the gym tenant paid for it because he needed more space in the property. So he's added value to the owner's property. And now right now you can't turn around and go, okay, well now you paid for the whole closing this space off. Now I'm going to charge you more rent. That'd be really, really horrible as the landlord. So once that gym tenant goes, then the next tenant that comes in, then they'll charge them for that NLA. And
but if you went to sell it or whatever, you'd be able to, you'd increase
definitely. You would, because you could say look, this person's only leasing this part, they're not leasing that part, but now it's been closed in. Literally 100 square meters could be $1 million of value, literally. So it's a huge, and it only costs the actual tenant about $30,000 to close in with some sheet metal and a roof, and that's it. Pretty simple, and it's a very, very good strategy if you can find this type of property.
Yeah, but if you buy one of these gym, you buy a lot of the CrossFit gyms where I live in Cronulla, they've got them in the industrial estate where you can do these simple basic value adds. Hey, one place is vacant, put a little extension out, add that value to it, and then try and get your hands on one of these tenants that are able to do it and charge that extra money. Spend that 30 grand up front yourself.
Yeah, it's just finding a space that has unused rear yard or unused side yard or something. And this is really, really common. In any type of commercial property, usually there's some a freehold property. Usually there's a little bit of space somewhere around the property that can potentially be used or closed in or something like that. And it's just having the eye to actually see it and utilize it. James Dawson famously had a retail property in Bondi, and he actually got manufactured apartments to be built in a factory, and he made apartments and just connected it to the top of the retail building in Bondi. It was just airspace that wasn't being used. So your roof is also gross floor area or net lettable area that could potentially be utilized. So I don't know the numbers on that, but you could imagine, putting 4 apartments in Bondi, how much value that would have added. And it was manufactured units that, wouldn't have cost, more than $800,000 to actually, manufacture, put together, do a whole crane operation and stuff. It was a big deal. This was years ago. But, things like that. It's just having the vision to be able to see things like that. That can create huge wealth and huge value.
100%. Number 3, what do we got?
All right. So add a shed or a garage to the underutilized hardstand, creating more NLA and start charging rent for it. So can you see a pattern here? It's about creating more NLA. If you can fix and solve this problem, you can add huge value, net income, and value to the commercial property. So think about putting in a shed. or a garage. How hard do you reckon that is to develop a single shed onto like a freehold property? Is it
Yeah, I feel like the
hard?
word develop is probably a bit of a stretch. I feel like
Exactly.
it's Lego set.
Yeah. So like is putting a
Never put
shed
up
or
a
a
shed.
garage on a freehold industrial property, would you say that was easier than renovating a kitchen or renovating a bathroom? Which one would be harder? Which one would cost more? Like realistically.
Yeah, which one has
Probably
more
the
rustic
bathroom.
style?
So the bathroom would cost more. So the thing in turn, the shed would be easier because it's just a shed. All you have to do is get approval from council, and you could probably put it in yourself. Like it's not a big thing, and all you have to do is then start charging rent for it. So that could be another tenant. That could be the same tenant that need more space. So with like warehouse property, a lot of the tenants, they need more space. They need more storage space. So you could just be increasing the rent that they're already giving you. So it's a very, very good strategy as well. Very, very easy to do.
Yeah, that makes perfect sense. Okay.
Next one.
Number 4.
Add multiple sheds to an
Oh, that sounds like
underutilized
number
area
3. Hang on.
along a boundary, self-storage style, and have multiple tenants paying you each month. Now, obviously, this is a better than the number 3 because you have multiple tenants, literally like boundary areas, any kind of underutilized area where you could potentially put 3, 4, 5, 6 sheds. Could be a huge value add. Like if you're looking at like a 6x3 shed, on average, like that would probably return about $350 to $400 per month per shed.
Forget the granny flat.
Yeah, this is like just that's what I'm saying. It's like I'm not trying to change anyone's mind. I'm just purely saying why I like commercial property, and hopefully people can just understand. This is pretty easy. Like it's just numbers and maths. If you can do basic maths, you can do commercial property. You can be a successful commercial property investor, and it's a lifestyle asset. So if I can get a commercial property and have that returning 100K to me per year net, like I could live off that. Like,
well, one of my,
I think that term lifestyle asset.
Yeah.
Sorry,
well, Jeff. I'm kind of confused about the term lifestyle asset as well.
Because to me, a lifestyle asset is you go and buy an acreage or something, or you go and buy a serviced apartment on the service paradise. So that's a lifestyle asset to me. But I see the context you're using lifestyle asset here. It creates the ability to live your own lifestyle.
That's right. So I'm not talking about what you're talking about. I'm talking about an asset that gives you the ability to have ultimate like live life on your terms and pay you to own it. So to me, that's a lifestyle asset where it actually pays for my lifestyle.
That's the thing I think find quite interesting about commercial is that you can have like the vacancies are larger. It does cost more money if you have a vacancy, and it does take longer to fulfill these vacancies. But if you're making 40 grand a year and you can do that for the first year, 2 years, you've then got 80 grand in the kitty that just sits there.
Yeah.
And let's say you do have a 6-month vacancy. So that's 20 grand. You just don't spend all of that money. You just keep it in the account ready to go. And if there is a vacancy, you just take it out of that money. Then 6 months later, you get it rented. And then all of a sudden you're making your 40 grand again.
Yeah, that's right. And with a commercial property, it has a higher return, right? So it can weather a higher interest rate. So it gives you more flexibility and lower risk of complete like lack of income. So a commercial property, if it's set up properly from when you're purchasing it, it can weather about an 8% interest rate. That's because a commercial property has a larger deposit that's put down. So you're actually only paying interest on 60% of the value, and the 40% gap is actually giving you that return. So if I actually have a inflation risk analyzer that people can go and download from my website. It's actually my DIY cash flow kit. You get three spreadsheets: your value add spreadsheet, a cash flow calculator, and an inflation risk analyzer. And you can see this for yourself. Like if you just go up there and put all your details in for your property, you can see how high the interest rates can go before you're underwater with that property. And it's literally like 8% interest if the property has leverage with about a 60 to 70% LVR. It just, you could still be making $5,000 a year on that property if interest rates go crazy high.
One of the questions that's popped up, it says, looks like I'm putting a 20-foot container on the side of my shed to up the rents. Now, it's a good one. It's funny. But my question is, like, how do you think about the business? Like, is there a way to think about the businesses and the demographics of the people that are coming to your area as well? Because, I mean, this person's making a joke by putting a 20-foot container up there, but really you have to know the people and the businesses that are interested in that area, because that 20-foot container might actually work perfectly for one demographic. But then you do it on your shed, it's not going to do a thing. You're not going to add that value. So how important is it to understand businesses and things like that?
It is very, very important. And that remark, if it was meant as a joke, it's actually not funny, because it's actually a legitimate way to make cash flow. Like, literally, like, that's a very, very good way to do it. Depending. So it might be funny, but it literally is a great way to add cash flow. Now, in terms of fixed assets, so if you're just putting a container in, then that doesn't always translate to added value with commercial property. It can for self-storage when it's done at mass, right? And it's more of a business, because when they're valuing self-storage, it's also an enterprise value that they're looking at. So it's the business that you're buying into. So if there's 100 like containers on a property, then they'll value that with a return as in an EBITDA for the business. So that can be a great strategy. With a commercial property, it's better to have a fixed structure. And that's why I left the container out of the top 6 list, because you can guarantee extra value whether it's a fixed asset and you're renting that out. With a container, it can happen, but I wouldn't bet on it. So, like, there are a few other different ways that you can add value to commercial property that I have left out that are more novel, like adding in a digital sign. That's a very, very good way to add income to the property if you're on a main road. But then again, that doesn't always translate to added value, and that's why I left it off this list. And then another one is also a cell tower. So putting on a cell tower, if you have the opportunity, can be a huge value add. But because, like, the cell tower companies have a specific need and there's only so many properties they can do that with, you're very, very lucky if you have the property that they need to do that. But it's just not the things in my top 6 list are the easiest value add strategies that you can definitely do. You're not guessing, you're not speculating, you're not waiting for someone to tap you on the shoulder and say, hey, I want to put a cell tower on your property. These are things that are actionable that the audience can go and do today and start looking for.
Mm-hmm. So
right. Number 5.
What are some of the things I need to be looking out for? Because the way I think about commercial property is that it doesn't transact as much as residential. Residential is constantly transacting and flowing, whereas commercial, it's kind of like older money. And I'm thinking that these people, like these older people, have been getting a great cash flow. They've already got debt free, they're income free. They don't really care about adding an extra shed to juice the lemon juice the juice as much as possible, because they've already won the game. So you can buy those type of properties and add value to them. Like, what are some of the things that I should be looking out for from an asset perspective? Like, what kind of deals should I? Oh, actually, gosh, that is underutilized. Are there any things that when you're scrolling through real estate that you say, yeah, that's mine? I can see some value out there.
So you need to be looking for like spaces that are underutilized. They're not being used properly, or you can add something in, and you need to be looking for under rented property. So it's being rented for a lower than market rate per square meter. This is what this whole presentation is about. Just finding underutilized property, and then you being the active investor, getting in there, getting your hands dirty and figuring out the strategy, and then putting a small little strategy in place that could potentially only make you $5,000 of net income per month, but that can actually result in like $50,000 of added value to the property. So it's like a huge return for your money. And I'm going to be able to show you that and calculate that after we finish these slides. So Don't leave. You will be able to see this in real time in CP data when I show you the value add calculator. So
what's number 5?
Number 5 is add a mezzanine. Seriously, it's that freaking simple. A mezzanine is literally one of the best value add strategies that you can actually find, because all you're looking for is a property that has a high ceiling and has the room to put in a mezzanine. So if you're
What
looking,
is a mezzanine?
a mezzanine is a level in a like property that is potentially used for storage, or it could be used for office. It's just usually a timber structure. Could be, 100 square meters to, 20 square meters. It could be anything. But it's usually very, very low cost to put in. You do need to go through council to get it done. You can have a legal mezzanines, which if it's a legal mezzanine and you try and get it valued, then they won't count that net lettable area. But the essence of it is you're creating a mezzanine that's creating more net lettable area, that's creating more income, and that's creating value. It's a very, very simple strategy, and it's a very, very good strategy that a lot of professional investors do. And you can do this not only on a freehold property, but a strata title property as well. And that's why I like it, because a lot of people that are probably listening to this,
there.
and a lot of people that are probably listening to this are probably going to be buying lower value property, and it might be a strata type warehouse. So you could still execute this strategy on that type of investment. Any questions?
Just cautious of time here. So I do want to kind of tear through some of these, and we're at number 6, obviously. So we're not far gone. What is number 6?
All right. Number 6 is identify under-rented property and raise the damn rates. So this is what we've been talking about the whole time. If you can just identify under-rented property, that's the rate per square meter that you're charging your tenant, then you can potentially increase the rates for no money of your own putting in, and you're literally creating value with just your pen. And that it's literally that simple.
What are your thoughts about buying a commercial property that is not rented? So you're going even more crazier there when there's no rent coming in whatsoever. So the cap rate, I imagine, well, it's not calculated on a cap rate. This is what the asset's worth.
Yeah, well, that is more of an advanced strategy, and that's why I left it off this list. So when I did my 13 ways to add value to industrial property on my podcast, that was one of the strategies, because a lot of investors do that. So they'll buy a vacant property, which they'll have to pay GST on. That's the very big downside of buying vacant commercial property, is then it's not considered a going concern. It's actually now triggers GST. So then you'll be buying that at a discount, right? So what they'll do with that is when they're valuing it, the value will look at it and they'll look at how it could be rented. What could the potential cap rate income be? And then what you should try and do is try and get that at a discount, and then the effort going to get a tenant in there and then get a better lease on that property, that's your value add. It's a very, very good strategy, but you need to have reserves and buffers in place to do that. And it's a more advanced strategy for an investor that's further along their path, because they need more money to do that, because you could, if you get it wrong, have a long period of vacancy as well. Great way to do it. Many people do it, but I wouldn't recommend it for the type of audience that we're probably speaking to now that's starting out.
Interesting. Okay.
All right. That's the end.
That's the end. Oh.
All right. So if you guys actually do want to jump on and get my DIY cash flow kit, you can go to that website, www.andrewbean.com.au. But now we want to move on to the next part of the live webinar, which is going through to CP data. And this is where all the magic happens. And I'll be able to show you the actual returns and the value add strategy that we can do. So this is what CP data looks like. It's one of those things that it makes a lot of sense to me because I understand numbers. It takes into account you already knowing and understanding what commercial property is.
Do you want to command plus it a couple of times? Just zoom in because it's quite hard to see. We can see you're in. Yeah, there you go.
Now?
There we go.
So it's one of these things. It's It actually goes down to the location. It doesn't go down to the address level like your CoreLogic or your Price Finder. So it's not that type of tool. But what CP data does is it takes in commercial property data Australia wide for many, many markets. You know, we've got plenty of markets here that lots
All
of
the
people would,
markets.
yeah, most of the markets. And then it breaks it down into the three main sectors. And this is what the other platforms like CoreLogic and Pricefinder don't do. They don't differentiate between the different sectors. So we could do that obviously in retail, office, and industrial. And this is able to give us proper data that you can use. And it's not data like a CBRE would give you, something like that, where they're talking about really large investment portfolios and things like that. This is like the whole market. So it's everything. There's no punches, no manipulation of data. If it's good, it's bad, it's in there. It doesn't matter to me.
Hang on. Is this a good market? Industrial, 4 sales transactions, and there's 48 for sale.
Yeah. So it's 3.1% stock on hand. So if you're looking at a stock on hand percentage, this is 3.1. So this is only March. So the first part of CP data only goes to the actual date, which is the previous month. And you can change that, you know, whatever you want to actually look at. But then if you go down, we can see the trending graph. So this is trending graph for retail. So in March, there was 3 transactions for retail. In February, there was 1. In January, there was 5. So you can see what's happening in a market over a long period of time, 12 months. So you can see how many are for sale in May 2022.
Well,
and
so my question to this is, what's happening to all of those deals? We've got 3, 6, 7, 5, but then we have 30 listed, 37. So they're just dropping. Like none
they
of
stay there, or
transacting.
they go on and off the market. It just really depends. So
Mm.
like, you know, you might have a constant, you know, on average about 35 properties here, but only ever a few will get transacted. Like not all properties get transacted that are on the market. Some stay on there for months, 12 months, 2 years. Like commercial property is different in a sense. Like if you've got it wrong, why would anyone buy that asset? So, you know, we can go through, you know, office and we can go through industrial, and you can see where the listed stock on hand, and this is the sales data. It's, you know, flows through. So you can see there's been a steady stock on hand of 2.9 to 3.1% over the last 12 months, right? And then if you want to compare the sectors, this is what this graph's for. So we compare the sectors, and that's a little bit harder to understand. But if we go into up here, see how you've got a cap rate range here. So what we do is this data is really hard to collect. Like this is all done by hand. It takes me and my team a month to collect it. And then once we post it at the end of the month, we have to start again for the next month straight away. Like this is really time consuming to do. So
Painting
like
the Golden Gate Bridge.
Sorry?
Painting the Golden Gate Bridge.
Yeah,
You get to one end and then you got to restart all over again.
And what we do is we give a cap rate range because there are so many different types of assets. You can't like have them all listed here. So we have to put all of retail and all office and all of industrial into the same like range. So if you're looking at like industrial we're in Newcastle, I think. So on the low end, great properties there, like A-grade properties with fantastic leases, they're showing signs of it's been trading at a 4.7%. So that's a 4.7 cap return on your money. And on the high side, that's actually 7.71%. So the 7.75%, sorry, might be a property that's really ugly. It has like bad lease. It needs work. So there's a range there. So if you find an asset and say like you have to determine where it is on this cap rate range, and you could say, oh, hang on, they're asking a 4 cap for this property. That's really sharp. Like that's ridiculous. There's no way this should be a 4 cap. So you can go back to the agent and say, look, no, like nothing's trading at that 4 cap right now for industrial. Maybe we should be more of a 5 or a 6 cap. Like, you know, so it just gives you the tools and the data to understand where you are in your market. So if we go over to like say leasing, this is where it really gets exciting because we give you a rate per square meter guide, like a range.
Wow.
So say this is really hard. Like this is really hard to get
massive range for retail. $130 to $1,200.
Yeah. So it's just really, really hard to get the data because you can't just go somewhere and this isn't like a data dump that we pay for and we have to collect this by hand every single market. And then getting the cap rate range is a whole different ball game again, where we have to call every single agent in the market and then use that information to correlate with the data that we already have, like listed and sold properties, and make sure that the ranges that we've got align with what's happening in the market at any one time. So if you're finding, say, an industrial property, and if we go to the value add calculator here, can you guys see that? Okay,
zoom in a bit more.
I can't zoom in anymore without. I can't zoom in with the calculator without showing everything.
Oh,
is it all right? No, it won't work.
Okay,
it won't work. So let's pretend that we bought this property for $1 million, and we're getting $60,000 of net income, and it's the net lettable area on the property is 500 square meters. So it's a pretty big warehouse. The market cap rate, the market rate per square meter is $120 that we're paid. But we can see here that the industrial rate range is $85 to $400. So maybe this property needs a little bit of TLC, or the tenant's on a short lease and then we're going to re-tenant it. So we might be able to push this up by, say, $30 to $150 per square meter. And it's only $30. What's really that going to make a big difference in the scheme of things? So the market isn't changing. The market cap rate isn't changing. So we bought it at a 6 cap. We're going to be valuing it at a 6 cap. But the only thing that's changing is we're going to change the rate per square meter to $150. And I'll show you the magic that happens. All I'm doing is $30 extra, and I've created $250,000 of equity in that property because I've raised the rate $30. Is your mind blown? Is that what happens when your mind is blown? That noise?
I can't see.
I've switched off. Yeah, I'm cooked, to be honest. I'm done.
Can't see. So, if you want to make money in commercial property, what you got to do is raise the rents.
Yep.
Increase the NLA.
Increase the
NLA.
Increase the NLA, increases the income, increases the value.
What else?
That's it.
What else do we have to do?
Well, you got to look for under-rented property, like I've said the whole way through. It's been a common theme, under-rented property. And, you don't have to use CP data. You can figure this out yourself. It just takes way more time. So to be able to figure this out yourself, you're going to have to put a week of phone calls in to talk all these agents and understand where you are in the market, whether it's a low rate. The reason the CP data exists is it gives you the tools to do it in 5 seconds. So we've done all the hard work for you, but by all means, get your hands dirty and get in there and start making calls yourself. And you can really find some great deals out there. You just need to have the knowledge and the understanding of what you're looking for.
There was a great question that came up. Anyone else that has a question, we'll jump into question time right now. Here is a great question by Ross. What is an acceptable and common due diligence period when you're looking at a commercial property?
So prior to the interest rates going up, depending on the asset, if you had any due diligence period in there, you would have got knocked back. I know Steve was putting 7 days on his contracts for a very long time, even 14 days, and that was tight. Right now, 21 days, that's business days, is a pretty good amount of time where you should be able to get your building and pest, your valuation done, and all your other checking the lease and stuff done within that 21-day business days. So it's a big difference between just saying 21 days, because that's calendar days. If you say 21 business days, you're actually getting heaps more time, which is really the words actually really change.
Just make sure you read just make sure you read the contract, and the contract is the right word rather than they've made the right.
Yeah, because when you're putting in an agent, you can say 21 business days, and then they write 21 days.
Yeah, well, this is actually one of my tips is that what you want to do is when you're putting in your offer, you know how you'll just put in an offer to the agent and then they'll like write out the contract and send it to your solicitor. While you're sending the offer to the agent, while it's still once it gets accepted, you should send your offer letter to your solicitor too, so they can understand and marry up are the terms and conditions that you've negotiated and got accepted exactly the same. And going further, one more step on this, you can have the vendor or the agent ask the vendor to print it out, sign it, and send it back to you with your terms and condition on it. And then when their solicitor says, hang on, no, we wanted calendar days, not business days, then you just hold it up and say, hang on, I've got the signed copy here, what the vendor signed, and you can clearly see it says business days. So you can kind of mitigate your risk there. But definitely having the agent, your solicitor, giving them a copy of your terms and conditions that you had accepted, because agents will take that word out of there. They're very cheeky like that, so more often than not, they will.
Yeah, they want to get paid their commission.
Yeah, that's right.
Are there, so is days on market important from a commercial standpoint? Like, do you see a tightening, like in the residential space, you see a tightening of days on market being an important metric that tells you that people are soaking up these properties? Is that something that's interesting in commercial, or
it's
it just
not
doesn't happen as much?
It's not as relevant in terms of like commercial property, because commercial property can take a while to transact. So it's not usually a 42-day contract. It could be longer than that, because financing on a commercial property is usually a lot more difficult, because they're not only assessing you as the borrower, they also have to assess the asset in its own rights. So to make sure the asset stacks up in more than one way, like not just the income, but the location as well. So a commercial contract can take longer to transact. So in theory, then it will look like it's a longer days on market. So it's not something that like I track or anything. You can noticeably see when when properties get taken quickly, but it's not as prominent as a metric to look at in commercial property as it is in residential property.
Interesting. Okay. Cool. Yeah, that makes perfect sense. Well, if anyone has any more questions, there's been a whole heap of banter thrown around. I'm just kind of looking for the actual questions. I mean,
I think this one's a good one. I like this one. What does a tenant who is late miss payments do to your value?
Sorry, I missed that, mate. What is a tenant that's late miss payments?
Yeah,
do to your value. If you jump on the other page, you'll see our screen.
Oh, yeah. So in terms of like, it depends how late. So once there's you have a late payment, you put in a letter of notice with a notice from your solicitor or your rental agent, and it doesn't hugely affect the property value unless you're losing the tenant. So if they're not going to pay and then you lose the tenant and then you have no tenant and you try and revalue or sell it, then that does change the value. But in terms of little squabbles between month to month of, getting your actual income, the only time that really can have an effect is like when, say, you're selling the property and the person that is doing the due diligence will look at the rental ledger and they'll see that they're always late. So they can see that they're a bad tenant. So if you have a bad tenant, that might put the purchaser off buying that type of property because you're inheriting a problem. So in terms of like value from a bank, though, unless they're not paying you at all and you're losing that tenant and then it's vacant, then it doesn't have a huge effect. But obviously you want to get paid and you're doing this to make money. So you want to try and make sure that during your due diligence, you can see that they're paying on time every single month and they're a good tenant to have. Like in self-storage, you inherit a lot of bad tenants a lot of the time because the business that you're buying has been poorly managed and they've trained them to be a bad tenant. So your job is to put processes and business processes in place that train them to be a good paying on time tenant. And that's the difference between like self-storage and commercial property.
Unreal. Yeah. Well, we've done an awesome session on the self-storage side of things with you, and I still want to dive deeper into it because I think there's so many opportunities there. If anyone has any more questions, throw them in now. But where, Andrew, can people learn more about you? Where can they get this? This hasn't been enough. Today has not been enough for them. They want to understand the commercial world a little bit better. They want to understand it simply. How do people learn about you?
Yeah, so I've got a few websites. You can go to commercialpropertyshow.com.au. That's the podcast website. You can, jump on to anywhere where you get your podcasts, type in commercial property, and, the Commercial Property Show will be the first one that'll pop up. You can also go to my personal website, which is andrewbean.com.au. And if you want to check out CP data, you can go to commercialpropertydata.com.au. So it's all about commercial property and everything. So I'm very, very aligned with everything I do. And, thanks for having me on the show. I've really enjoyed, being here, guys, and just want to commend you both with the massive effort that it takes to create content like this every single week in and week out. So hats off to you guys for putting in a massive effort, because I know, being a content creator myself, how difficult it is. And, you guys are doing it really well.
Thanks.
Well,
thanks, mate.
I mean, you did a lot of the work. You did a lot of the work today, mate. So I appreciate you. We've got a little a cheeky question that's coming here. How much is CP data, and are there levels of subscription?
Yeah, so CP data is $89 per month. You can jump in and do a 7-day free trial. No questions asked. And if you let me know that you're an Oz property listener, then I can give you access to all locations, because usually in that 7-day trial, you only get access to one location. So it gives you a little slice of data. But if you're an Ozprop listener, let me know and I'll give you access to every single location. So theoretically, you can get your data and, move on. But I'm not really, I made it for myself. Like it's just an added bonus to be able to get a little bit of money from it, like a little source of income. But, if it can help someone in any kind of way, then that's really what it was created for. And if you are going to join CP data, you need a Google email account. That's the biggest constraint that it has. It's created with Google software. So you need a Gmail. So sign up with a Google Gmail, and that'll make the whole process a lot easier. Because if you don't, I'm going to have to get a Google email off you. But
like a Google Sheets cash flow calculator show.
It's done through Google Viewer. It used to be called I can't remember what it used to be called. It changed names, but the dashboard style is what it is. It's just for basically businesses to understand metrics through a dashboard style. And I was able to create the platform through that, because creating like a platform like CP data requires is like a huge investment of, time building it from scratch. So I had to build it in the most economical way, which was using off the shelf, software. And that was the easiest way to do it. With the least amount of capital invested. So need a Google email account.
Yeah, that makes perfect sense. And also $89. I thought you were going to say like $800 a month. Like at the end of the day, if you're buying a commercial property, we're talking like $89 is okay. It's nothing.
Yeah, so literally the information on that platform could make you millions. Like if you just understand the rate per square meter, and you're paying $89 to get it, or even you're just going in the free trial, that could be hugely wildly advantageous to you. So yeah, I mean, I probably should raise the prices, but
yeah, great comment here. It says great content tonight, reinforcing what we're already doing. I'm looking for a container right now, and I think that's half of it, right? Like people are already out there doing this kind of stuff, but there's not this type of content where people are talking about how do you actually do it. And then you realize, no, it is this simple. This is exactly how you do it. And this is how it can be done. So yeah, guys, good luck
100%.
with,
I'll just say to that Facebook user, be wary of buying containers from Facebook. There are a lot of scams for containers. Literally, there are a lot of scams for containers on Facebook. So make sure you're buying it from a reputable container provider, because there are countless people that have been scammed. So one of my other projects, my client projects, we're building a little self-storage mini facility. So we're splitting up, we're buying 5 containers, we're splitting it up in half, like half of them in the middle, and we're putting roller doors on each side. So we've got 5 containers, 10 spaces, and I we're getting this from a reputable container provider near the location. And he told me, yeah, people are actually coming to me and saying, I've ordered containers from you. When can I pick them up? And the guy's like, oh, you never ordered from me. Like, he's like, yeah, I ordered online, like through Facebook, because people are saying that they are that business. And then when they go to get the actual container, pick it up, there's never any order and they've just lost, you know, a lot of money. So a container can cost, a 20-foot container can cost easily $5,000. A 40-foot container can run you like $8,000. So like, you know, when you're buying, we were looking at buying like 30 of them. So it's a lot of money.
Wow. Unreal.
Make sure you speak to people and do all that sort of due diligence on the business as well, and speak to the actual.
Jump on the phone. Get
dialing.
Jump on the phone. Jump on the platform. Thank you very much, Andrew Bean. This has been a very insightful episode. It's all about value add. I haven't heard anyone speaking about commercial value add. So thank you very much for jumping on, mate. That was epic.
Thanks very much.
No worries, mate. I promise that I blow your minds, and hopefully I did. So
a commercial property. See you guys. Have a good one.
See you guys.
Thank
you.
Catch you.